Ladies and gentlemen, today marks a pivotal moment in our financial history. The stock market has plunged to a 5-year low, sending shockwaves through the global economy. This drastic downturn stems from the newly imposed tariffs by President Trump, a development we've been cautioning about in our previous discussions. On April 2nd, President Trump declared a 10% baseline tariff on all imports, with certain countries facing tariffs as high as 49%. These measures have ignited fears of a full-scale trade war, leading to a staggering $2.5 trillion loss in the S&P 500, biggest one-day loss since 2020, and rekindling concerns of stagflation. The immediate aftermath was brutal. The Dow Jones Industrial Average plummeted nearly 1,700 points, the S&P 500 dropped 4.8%, and the Nasdaq Composite tumbled 6%. These figures represent the most significant single-day decline since the 2020 pandemic-induced crash. The ramifications extend beyond the stock market. Major trading partners, including China and the European Union, have announced retaliatory tariffs. China, for instance, imposed a 34% tariff on American goods. This escalation threatens to disrupt global supply chains and inflate consumer prices. Consumers are already feeling the pinch. Prices for everyday items like electronics, clothes, and automobiles are expected to rise. Retailers are urging shoppers to make purchases now before the full impact of the tariffs is felt. In these uncertain times, it's crucial for investors to remain vigilant and proactive. Here are 2 key strategies to consider. Tip 1. Diversify your portfolio. Diversification is a fundamental principle of risk management. By spreading investments across various asset classes such as stocks, bonds, and commodities, you can mitigate potential losses. Consider reallocating assets to sectors less affected by international trade tensions. Tip 2. Maintain liquidity. Having accessible cash reserves provides flexibility during market volatility. This liquidity enables you to seize potential investment opportunities that may arise as asset prices adjust to new market conditions. We've been cautioning about the potential fallout from aggressive tariff policies, and unfortunately, these predictions have materialized. The current landscape is fraught with uncertainty, and it's imperative to stay informed and prepared. We are in uncharted waters, and the path ahead is uncertain. It's more important than ever to stay informed and make prudent financial decisions. Subscribe to our channel for the latest updates and in-depth analyses to help navigate these turbulent times. Subscribe now to stay ahead and make informed decisions. So, does this mean we should panic and sell everything? Absolutely not. Selling in panic often leads to locking in losses, the worst possible outcome. Remember, the market moves in cycles. While this downturn is serious, those who sold everything in past crashes, like 2008 or 2020, missed out on the massive rebounds that followed. Instead of panic selling, here's what you should do. Reassess your portfolio. If you're overexposed to risky assets, now might be a good time to rebalance. But don't sell blindly. Stick to your long-term plan. If your investments are based on solid companies with strong fundamentals, short-term turbulence shouldn't shake you. Look for opportunities. Downturns often present great entry points for strong stocks at a discount. In light of the recent market downturn, I urge you to revisit our previous DCF analysis videos. I will be updating my price targets soon, even though some stocks are already hitting my targets. For instance, NVDA has already reached my fair value of $104. Stay tuned for more updates. The biggest mistake retail investors make? Letting fear control their decisions. Stay calm, stay informed, and don't make emotional moves. If you found this analysis helpful, subscribe now and hit the notification bell so you don't miss our next update. The market is shifting fast, and you'll want to stay ahead. Take care, and I'll see you in the next one.